Yes.
All right. Let me open the board. So again, the agenda of the today's session is try to cover even the calculation part, but see if it is lengthy, then we'll have to postpone that to the next week. But by next week, we'll ensure all key information that we have covered for private equity also, so that you can look for an interview after that. Where is my pen? Okay. So, objective of the today's session is to cover the because we have already discussed about private equity. What is private equity? If someone asks you, so I'm sure that you would be able to elaborate more on the private equity part, right? So you can split that private equity, fund, accounting, all are different tasks, and then combinedly we call private equity, right? For accounting. So all right. So here if you see, so in today's session we are going to cover about the management fees that would be in the private equity, or how we can calculate the management fees. It's a very simple term. Management fees which is required for operating expenses. Note down each and everything, please. Today's session would be very insightful and even essential for a private equity business. Management fees. All right. So it is a operating expense of the business. When we say operating, it means it's a mandate. So in every fund, there would be provision for management fees. Without that, how can we operate the fund structure? For example, let's say fund accountants, you guys are working as a fund accountant. If company, let's say, they don't pay the salary to you on time, so how will you work as an accountant, right? So how will you work as a accountant then, right? So it means your salary, including office rent, and everything. So all expenses which are on depends on the management fees, right? Whether fund earn profit or not, operating expenses would be must, because as an accountant, I'm sure that it's not your responsibility to check the fund returns or profit or loss or internal rate of returns, right? You don't check it because you are the part of recording and reporting team. You just record the transactions, you just report the transactions. That's it, and you ask for your salary every month. Correct. But eventually that will receive to you from the management fees or maybe sometime admin fees. Correct. And when we say fund, so it means you would see other expenses as well. Other expenses, there would be categorization of expenses. The management fees would be operating fees. And expenses which we say here, admin, custodian, broker, or any other operating expenses, if you see again, but in a reality or while working on a fund, so you would see two expenses. One is management fees and another one is partnership expenses. So note down this one. In a private equity, you would see partnership, custodian, admin, and management fees expenses. Most of the time, you will have to record the transactions or you will have to do the accounting for those expenses. All right. So, any question, guys? Who's this? Sit. Guys, please don't do this. Try to join on time because I'll have to change the tab every time. So that doesn't make sense. Sorry. So it means one task is management fees and another task or another activities or expenses that I would say expenses, it means other expenses that it can say. But here the important is management fees and other expenses most of the time that will be included in your capital call. Sometime not included in the capital call. Not included in the capital call. So task is yours to check whether the management fees or expenses which are included in the capital call or not. Why this is important? Because when you receive payment, you receive only single amount and it's your responsibility to calculate the exact capital call amount, to calculate the admin fees, partnership expenses, or other admin or any expense. If you see organizational expenses and all, you need to calculate that and apply the accounting treatment accordingly. Right? Same for at the time of distribution also. Distribution, it means return of capital process. At the time of returning the capital to the investor, you need to calculate distributions amount, means exact distribution proceed or exact return of capital amount, and return that to the investor. And when you can calculate it, you should know the expenses, monthly expenses, quarterly expenses, annually expenses, or any other expenses. If you see spot expenses, so it means at the time of calculation, let's say XYZ fees received, then you also need to deduct that fees from the net proceed, and then after you can announce net profits to the investor. So here with the private equity, 60 to 70% work that I would say you need to play around with the documentation and calculation part, because system calculate everything, system provide you everything, commentary and all. Your job would be to apply the accounting treatment to the net amount. For example, let's say capital call, system calculate capital call. Once you generate the statement that provides you the exact capital call amount, expense, fees, admin fees, everything that system provides to you. But your responsibility is to interpret that details and apply the accounting treatment, or apply or post the accounting entries in the accounting system like Investran or Geneva, or the many more other applications as well, because each and every institutions they have their in-house application. So you need to apply the accounting treatment to those transactions, right? And apart from that, the other operational terms that also important from your interview perspective. But let's see, we'll try to cover. So this head and distribution, we'll try to touch to the distributions today to see how distribution works, what are the different methods that the private equity accounting teams they refer. We have a prepared calculator so that we can use that for a calculation of distribution or waterfall and all, right? So any questions so far? Okay. So important is, in a hedge fund also we charge management fees. In a private equity also we charge management fees. Can you differentiate, guys, what is the key difference that you would see in hedge fund and private equity in terms of management fees? Come on.
Maybe in private equity, general partner would not be entitled to pay management fee.
No.
No?
So what do you understand when we say asset under management?
Total market value, total current market
Exactly.
value of the portfolio.
See, here with the hedge fund, NAV management fees will be charged on AUM base, asset under management base. But in a private equity,
Commitment based.
that's the key difference. Commitment means capital base.
So does general partner also need to pay management fee because he's the
Yes,
one who
it is
is
for everyone.
managing?
What if fund manager is different one and limited partners and general partners both are different one? They have
What ab-
contributed 80, they have contributed 20, and that 80-20 amount transferred to the fund manager. Fund manager is from the different organizations. They are managing the investment. Then of course, this fees will incur to both limited partners and general partners also.
then how about if they are same?
Same fee, same terms.
Okay.
Because it's a operating expenses. It's a mandate to everyone. It's a operating it means without those expenses, how fund manager will manage the operations then? As I already told, if the fund manager, let's say LP and GP, if they don't process management fees, then he will not receive your salary. Simple. It's operating expenses, whether fund perform well or not, but still he will receive your fees or your whatever in a percentage defined, you will receive that.
Keep it here.
All right. Those are mandatory expenses and mandatory expenses that they will receive to you. That's the difference. So here you can note it down. So if you're looking for any interview, so you might expect question around it. So what is the difference between hedge fund and private equity management fees? So here in a private equity, commitment based fees that we charge. In a calculation, we'll see that when we'll calculate it. Again, management fee structure. So here, see the depending on the structure, this can either be a straight fees charge. Straight fees, it means commitment base. Commitment, when we say commitment, it's a capital. Charge to the fund or priority shares of profit up to the fixed amount. So depends on the structure, but most of the time they prefer straight forward fees, right? Management fees more commonly seen in non-UK funds. So this is for a global market. So most of the time management fees that you would see in a non-UK funds, UK funds, so they might charge expenses for manage, means separate expenses they charge, not exactly management fees, right? And then fees and some European funds, accounting perspective, financial statement under IFRS and US GAAP, expensed through profit and loss and not shown as an allocation of profits and gains regardless of how these are structured. Accounting perspective under IFRS and US GAAP, expensed through P&L, not shown as an allocation of profit. Okay, so it means UK GAAP and US GAAP, it not allows the management fees to allocate it. So they just update the P&L, profit and loss account statement. So directly post the management fees to the P&L instead of allocation, means to the capitals. Accounting perspective, capital statement, capital statement, partners capital PCAP, NAV and capital account balance will be shown net of management fees GPS and PPS. Let me check the GPS and PPS full form. That would be GPS and PPS. Priority profit shares. PPS, it means priority profit shares. If you see any priority, it means if they have issued any units to the any investor, means priority, it means to provide the preference in that way. And GP, it means general partners shares, right? So general partners and general partner shares and priority preference, priority profit shares. That's, you can see structure in European market in, and the other apart from the European. So you would see normally general partner and limited partners structure where management fees, that will come into picture automatically. So note it down their full forms, GPS and PPS. So management
GPS means
general partner share.
share.
Basically limited partners and general partners again, but they see, if the market changed, then automatically wording changed. So I just wanted to walk you through the important terms like that you might expect in interview. Okay. See this. Note down this also. So management fees. Management fees, offset. Offset, it means, can anyone tell me what is the meaning of offset?
Kind of write-off or reversal.
Hmm?
Write-off. Offset means like in order to make it zero.
It's not a
So
write-off.
Mhm.
See, you would record this where? P&L.
Okay.
So it means against income that will offset. And net expenses only you can transfer to the net expense or income, whatever it is, that you can transfer to the balance sheets in that way. Fees, income, and offset fees. So 100% offset more common are the variations. 80% offset where management fees is lower. Variable offsets. Full offset up to the level of abort cost. Abort, it means if you see any deal as such, if it's cancelled or any investment cancelled, that expenses you can say abort. And any excess 80% of remaining fees applied as an offset. Transaction fees, monitoring fees, director fees, underwriting fees, and other fees. So it means in a private equity, in a hedge fund, you will not see this. In a hedge fund against offset, it means here in a different way that you would see in a private equity. With the hedge funds, you don't need to offset it. You can directly record it to the P&L, or else you can directly allocate it. Depends on the structure. If you have a master feeder structure, or if you have any structure, so you can allocate the expenses, right? But in a private equity, your management fees that will offset against all these expenses: underwriting fees, director fees, monitoring fees, transaction fees, and other fees. So it means, let's say if private equity firms charge 2% management fees, then other expenses, transaction fees, monitoring expenses, director fees, all expenses will paid from the management fees only. That means, let's say 2% management fees is $10,000, and here let's say all expenses which are around $8,000. That means you can offset all expenses with the management fees. because eventually in a private equity, it's a partnership business. Why partners will pay commission to each other? So they'll pay or fees to each other. So where they directly pay the all expenses, if you see any expenses as such, variable, fixed, or any expenses, so that will be paid by the uh, all partners. But instead process transaction monitoring director fees expenses one by one, they just pay the 2%, 3%, whatever it is, management fees, and all expenses that will offset against the management fees. That's the key difference again that you would see in a private equity. So while doing private equity accounting, you should always check such a commentary whether, and this is not even fixed, right? This is not even fixed. Each and every fund carries some other features, so that you should check and again interpret it in an accounting or as per the accounting requirement, then only you would be able to apply the accounting treatment. So here you're seeing management fees offset. What if we have another fund, private equity fund, they don't allow to offset? So only PPM that define it whether offset is allowed or not. So you should check the fund PPM to see other terms and conditions that help you to understand what is the requirement of accounting and reporting. So as per that, you can apply the same, to that particular fund, right? So it's a very important one. So you should try to understand the private placement, a memorandum of that each fund, or if they have any additional documents, let's say term sheet or any documents agreement as such, if they have, so you can go through it. So that documents will help you to understand what are the different terms, right? This is it, it's a private equity business. Private equity, it means it's a customized business proposal. So both partners, they can have a different terms as well. So here you would see offset, so you might see, will not see offset with other funds. So anything which is not certain, even the 2% fees, that is also not certain. So this fund is charging, let's say 2%. So might see other fund, they have a different fee structure, let's say 3%. I have seen even 5% also management fees. So depends on the fund. So check the private investment prospectus. Okay. There are the common fees, but as I said, like, you need to offset that against the management fee, and you can also record this all expenses to the P&L as well separately. That depends on the fund structure. So check the private placement, that will guide to you. Then excess of organizational expenses, excess over the specified cap as per the LPA option against management fees. So it means for each and every head, they fix the cap. Cap, it means limit. For example, let's say 1200 USD for per annum. So this is the cap, means organizational expenses cap. What if for this particular year we have received 1300 expenses? So it means $100 extra expenses incurred, let's say due to XYZ reason. So that expenses also you can offset against management fees. If you see, if the expenses goes beyond the cap limit or limit, it means whatever predefined expenses cap was given to the fund manager, if the expenses goes above that, then you can adjust, or I would say you can offset those expenses against management fees also. But here again, it's not a mandate provision, it's organizational expenses. Sometime you would need to do this, otherwise you don't need to do it. But that again, guidance should be provided in the PPM. So check the PPM of that fund, and accordingly you can apply the accounting treatment. Then placement fees either borne directly by the general partners or managers. Borne by, it means, so they'll decide it, or they'll pay offset against management fees again. So they directly decide fees, how much would be the placement fees and all. Placement fees, it means investment fees. If I'm sending you the documentation and all everything, For example, let's say my class fees. If you see my class fees, it means I'm sending you that quotation to you directly, right? Otherwise, I can also ask you to pay GST separately, pay tuition fee separately, right? Pay cloud expenses separately. Pay means there are ways, right? Even I can ask you pay separately, or else I can also ask you to pay directly, let's say lump sum amount to me. I'll offset all other expenses against each other heads. That also happened. So placement, it means investment expenses. If you see fund managers or general partners, they can send it to you, and they can offset all that expenses against management fees also. So that depends. It's not, see, these are not certain terms. It's a customized business, partnership business. In a partnership business, you can define or design your terms, right? And that's what it's important to understand it. When we say um, partnership business, it's not the constitutional provisions. Okay, constitutional, it means those are the certain provisions and that needs to be followed by each and every fund. No, it's a customized terms. So here you might see placement fees where the general partner will send it or offset that to the management fees, or might be with the other funds you would see placement fees that will be recorded and processed separately. So you cannot means surely say anything as such. Those are the ifs and buts. So you would see that, but again, right? Even though if I take the example of this 2%, which is not fixed, so you might see 1.5%, 2.1%, 3%, 1.8%. So that depends. So it means nothing is certain or sure here. It's a partnership business. Partners comes with certain negotiations, and once they're agreed with their negotiations or whatever objectives that they have, then they go ahead with the investment plan. So it means on each and every PPM, on each and every limited partnership agreement, you would see different terms for investment. So always I would urge or request you, before applying any accounting treatment to the private equity transactions, you should go through the PPM or security purchase agreement or any other document as such. If the fund is maintaining, so you should go through it, which defines you or guide you about investment structure and all. And then after, you can easily pass the accounting entries or process the any or prepare any financial statement as such, or you can even prepare the NAV pack also. But if you don't read PPM, if you don't read SPA, if you don't read any documents which is related to the investment or partners contracts or partners agreement or terms, then that would be difficult for you to understand the accounting and all. All right. So here if you see one of
Sir,
the
may I know the difference between LPA and
LPA means
PPM?
agreement, limited partnership agreement.
PPM?
PPM, private placement. It's a, see, LPA already we discussed. LPA means it's a partnership agreement, partners agreement. And PPA, it means investment agreement. This defines about the partners profit, partners shares, partners investment, partners profit and loss, partners everything. Means it is all about partnership, how the partnership would be or should be. PPM, it means investment terms, how partners will invest, what would be the amount, rate, return rate, or investment details, everything that will be defined in the PPM. Because yesterday I showed you the site of IDFC, right, where we were trying to download the PPM, private placement memorandum. So issuer company, they issue the documents, and where investment companies, they announce, they sign the PPM, and once they sign it, that PPM define each and everything, including all other expenses as well. So this is all about partners. This is all about investment. If you're investing any IDFC company, then you can sign PPM with IDFC. All right.
Yes, sir.
LPA, Limited Partners Agreement. Limited Partners Agreement. So this is all about partners of the private equity fund. This is all about private placement. It is talking about investment. It's an investment agreement. That's the difference. Memorandum, it means it's a document which defines terms, conditions, everything. Okay. Then this term is, let's say, historically have noted GPs deemed contribution funded by the LPs to be applied as a reduction against management fees, but not commonly any longer. So we don't have to discuss this even. I don't see this anywhere. It is just old provision. Now it's a mandate. In India also, LPs and GPs both should contribute. So why the LPs contribute of GP's contribution? It's an old provision, not new one. Right? Management fees 2% again, which is not fixed. 2% is not fixed. This vary from fund to fund, depends on the fund nature, depends on the fund structure, depends on the fund's investment duration. That depends. But 2%, I would say it's a benchmark. So you might see +1 or +2, -1 or -1.5. It means around it. So you would see the fees structure. 2% is still more common, but seeing more variations recently, especially for a subsequent funds, right? Variation, it means due to inflation, due to labor cost increased, due to salary of accountants increased, due to facilities or internet charges or electricity power charges in US and Europe, if you see increased, right? Then ultimately management fees also that will impact, or that will be impacted dramatically. Correct? And that's the reason nowadays we have seen variations in management fees also. So which is not a fixed. 2% is not a fixed then. Okay. So here commitment period, common trend for a basis of a computation is still based on a total commitment. Variations of the percentage of drawn commitments and reduced percentage on undrawn commitment. Can anyone tell me undrawn, it means what exactly? Guys, anyone? Undrawn meaning of
Capital that is not called yet.
undrawn means
Capital
not
still yet not drawn or not utilized because they'll usually
not
call.
called, right?
Yeah.
And drawn, it means
Drawn means capital already called for some deals.
called.
Yeah.
Yes. Drawn, it means already called commitment. So you might see different percentage on drawn and you might see different percentage on undrawn as well. So that depends on the, again, investment disclosure, right? So check that and accordingly you can apply the accounting treatment. But again, I have gone through around 1000 ppms in last 1 year. So I haven't seen anything as such where they calculate and provide you the details on ppm or on investment details or capital call later. Directly, system calculates and provide you the terms like this is the net fees that you need to apply the accounting treatment and you need to apply the accounting treatment. But yes, see, fund managers and their core team, so they actually work on all these terms and they update their data and send that notices to us. And our job is to interpret that notices and try to record those in our internal accounting system. All right. During the commitment period, you would see different percentage for a total drawn amount and undrawn amount. So we'll discuss that with the examples, but theoretically you should know it. What are the different terms that you would see in private equity with regards to the management fees? Because management fees plays a crucial role. There are only three main tasks. One is fees, another one is your total assets computation. But before that, you would see posting of entries in the books of account, and third is your distributions, right? Distributions or capital call. So major activities would be three. Quarterly, you would see little tough, but every month then would be easy, I would say. But quarterly would be tough in a private equity. Post investment period, common trend for a basis of computation is on percentage of acquisition cost of unrealized investment and outstanding investment contributions. Net capital, net invested capital. Variation step down year on year. Net capital invested. Can anyone explain this? Means for first year you can calculate on a capital, means commitment, right? Whatever commitment that you have, 2%. But what about second year? What about third year? What about fourth year? Right? Let's say the investment duration is for fifth year. What about fifth year? So how will you calculate the fees? What would be the base? Can anyone tell me what would be the base? Invested amount. Base would be the invested capital. So every year fees would be charged on commitment. It means so next year also you can charge fees on invested capital. And in most of the cases which I have seen, where the fund managers, they already provide you the base of the fees is, let's say, this amount. Base of the fees is, let's say, this amount. So they provide you the base. Once they provide you the base, you need to charge 2%, 3%, whatever fees is given, right? Let's say for a quarter, for a year, then you can calculate it. So base will be provided from their side, but base would be again invested capital. Acquisition cost. Acquisition cost, it means invested capital. Acquisition, it means purchase price. Okay. For some debt funds, the basis for a computation used through the term of the funds is the outstanding balance of principal amount of a loan investment made to the investee companies. So it means if you see any loan fund as such, so total that management fees will be charged on outstanding amount, outstanding loan amount. For example, let's say initially it was invested 1 lakh USD. After 1 year, let's say outstanding is only 80K. Fees will be charged on this amount, not this amount. Initially, you can charge for first year, you can charge on $10,000, and then to the second year, then you can charge it on 80,000 K USD. Why, sir? So might be at 20,000 K where company already processed it as a pay down. That's the possibility. And where they processed it as a pay down, then you don't need to charge fees on that. So that definitely that you would have distributed it as a callable distribution, right? So we'll see that callable means there are a number of terms, key terms. We'll see that after this. Directly we'll jump on the your calculations, and then I'll help you to understand each and every key terms: pay down, total commitment, global commitment. Everything means everything. Through an example, we'll explain it. Right? But that you would see. So it means on an outstanding amount where the loan funds, they charge percentage or fees, and they provide you the base as well, as they have considered the base of outstanding loan amount and charge 2%, 3%, whatsoever it is. Okay. So this is something FYI information, not something that you can consider. So other industry trend, common terms, increasing the trend of rebates and discount being offered. Yes, I have seen that. So yesterday also I was just going through the private equity documents, means real private equity documents. I have seen that almost, means I have reviewed around 100 funds, private equity funds or LPAs, limited partnership agreements, where I have seen common thing, that is rebates. Rebate, it means discount. So for example, let's say total 2% management fees on 1 CR, it goes around 2 C, let's say 1 CR, 2 lakhs for per annum, right? 2 lakhs dollar for per annum on 1 CR commitment. So at the end of the quarter, so fund manager will offer discount, let's say on 2 lakh. So 10% discount will offer, let's say 20,000, and the net management fees would be 1,80,000. So in that way, the calculation works. So it means this is something you can consider discount, and this is something that you can consider gross management fees, and this is the net management fees which has received or which will receive, right? 20,000, 2 lakhs, 20,000 that will be debited as a discount, and then 1,80,000 which will receive from the limited partners to the fund manager. Why this train came into picture? So there is only one point which I could see, that is to attract or to get the attention of investor on the investment, as like the management, they'll also support to the investor in terms of management fees and all by offering discounts, right? So where they offer discount, most of the funds they offer a discount to the investor. So that's rebate, where it's a benefit of limited partners. If you are doing accounting in the books of limited partners, so rebate you can record it to the P&L credit side, right? And that negotiations you would see on a side letter, it means different letter where they draft to you as an accountant. You will receive different notification through different letter, negotiation letter, or maybe sometime you would see just common email that you have received where fund manager confirm it. So this particular fund we have offered, let's say 10% rebate on the net management fees. So you might see such a comment or lines in your mail. So you need to read carefully so you can apply the accounting treatment to those transactions, right? Then other trend which we have seen, fees offsets are mostly 100%, and placement fees if borne by the fund will also reduce the management fees. If the fund is paying, so it means 100%, so it means almost all the funds they follow the offset means other expenses they allow to offset it, and placement fees, investment cost, if borne by the fund will also reduce the management fees. So it means, what it means, if the fund is separately charging this placement fees to the investors and also charging, let's say 2% as a placement fees and 2% as a management fees, then nobody will pay them 2% as a management fees, of course. The reason is that will lead to the increase the expenses, and ultimately that will affect on the return on investment. So nobody allows it. So ultimately, if the expenses goes high, then ultimately management fees also investor will pay less. But yes, as the statement said, most of the time you would see it will be offset. Fees will be offset. Even investment fees will be offset. If not offset, so you might see then different rates as well. So that depends. And the last statement, where if you see general partners' overall budgets at times are facing increased scrutiny by limited partners. So it means nowadays, whatever budgets the limited partners pay to the limited partners. See, I don't know, this is a recorded session. I don't want to reveal the truth of this industry, or I would say, there are a number of events or instances which I have read or gone through it about frauds and scandals, right? So in a 50 to 60% cases, what I have seen, fund managers, they invest the fund in their, shell companies, fraud or forged companies, or I would say in a companies where, let's say, the relatives which are holding major investments and all. So those found guilty even. Go and check the FINRA site. So you would see that how much frauds that they have detected throughout their history. So means thousands of frauds they have detected in last couple of years. So funds like Tiger Group, even if you say Tiger Group is one of the popular or renowned name in this fund industry, private equity industry. They also found guilty in several cases. So where a stock exchange Nasdaq, and as per the act of Nasdaq and as per the FINRA regulations, they found guilty in several cases. There are many more renowned names. Renowned, it means renounced, even including Goldman Sachs, JP Morgan, those also found guilty in several cases, and the regulator then penalized them. The reason is, see, when we see the money, then definitely always see, as a fund manager, let's say you have transfer me 1000 crore to me, and apart from that separately you have sent 100 crore to me as a expenses and all. What if I don't utilize that 1000 crore and as well as 100 crore in an effective way, then ultimately that will lead to the losses. Correct? We have seen that even the same you would see with the mutual funds as well. What if I have invested? There are, let's say, A, B, C, and D. These are the companies. Let's say one of my close relative is holding all these companies, right? And I'm working as a fund manager here. So your investor, it means here, you have sent 1000 crore plus 100 crore as a fees to me, and I have invested that all amount in the cell companies. Now you think after 6 months or 1 year, let's say this relative declare all these companies as a bankrupt, then what about your money? Go and check it. Nobody gives the guarantee of 100% guarantee of investment. Nobody. Always they try to maintain their draft in a way like, once you claim it, hey, you lost my investment and I want recovery, they'll say like investment is subject to market risk. Before investing, you should read the documents, means investment related documents carefully, and then you should have taken the investment decisions. Why did you invest? Because investment is linked to market. And when we say linked to market, so it means market is volatile. I invested in these companies, but this investment companies got bankrupt. So what can I do? How can I recover your money? That happened. So ultimately, to prevent this fraud or to check it whether the fund manager is investing or uh, allocating money to the right companies or not. So it means nowadays scrutiny. It means examine or I would say you would see more interventions of limited partners in fund. So they'll look for each and every key information, and that's the fact. Because they appoint third party, they appoint trust accounting agents. You would have heard trust accounting and all. So they appoint trust accounting agency, they appoint auditors, they appoint special custody where they can take the custody of all these investments. Also, they limited partners, they also appoint vigilance officer as well, so where they perform the audit in details to check it how the investment has been placed or money has been placed across all the investment instruments, companies, the audit, the relations of fund managers, each and everything to prevent the losses, because amount would be very high. Go and check it. You would see billions of dollar investment that gone in when just because of audit and scrutiny wasn't performed well by the auditors or even the limited partners and all. And that's the reason limited partners nowadays, those are like educated one, they know how the investment works, and they would prefer to review each and everything closely, right? Anyone, any questions so far? Guys, any question? Yes, no? Are you there?
No, no, no.
Okay. So practical consideration, this is also important while calculating the investment, that management fees. Calculated on a daily balance basis or as at period end basis. So you can calculate management fees on a daily basis because it's important it means, and even though you know the amount, right, you know the balance it means commitment balance, you can charge it 2% on this balance, and 2% whatever amount would be, split that across 360 days, that becomes your daily. And once you split across 360 days, then you can calculate the fees, means daily as well, and provide accounting treatment. But in a private equity, your accounting would be on a quarterly basis, and most of the funds limited partners, they pay the fees. Limited partners pay the fees on a quarterly basis. So quarterly you will receive payment. Daily you can do the accounting if you want, and quarterly you will receive the payment of previous quarter, right? Then you can offset all the expenses, whatever that you have. Basis for adjusting disposal and write-offs, partial or full. Sometime you will have to do partial and full write-offs as well. Why write-offs will come into picture? Can anyone tell me? Why write-off will come into picture? Come on. So what do you understand about write-off? Write-offs. Have you heard about write-offs, guys? Write-offs. Have you heard anyone? Am I audible? Are you there, guys?
Yes, yes, Shiraj.
What do you understand about write-offs? I'm sure that you would have
Write-off
that.
means like we will not be realizing the value, so
Hmm.
hence that would be like written off to the fund.
So
That
write-offs
would
it
be
means,
charged to the fund back.
write-off it means,
Just like a bad debt kind of a scenario, right?
yes.
Because
If you
we'll not be
see, let's say
realizing anything.
fees is accrued, but at the moment the investors or limited partners, they are not ready to pay it, then it will have to also write-offs as well. Write-offs you can do it in case of if the fees is means limited partners are not able to pay the fees, then you can partial or full announce write-off with that fees or expenses. Right, that also happened. Post investment management fees calculation, flexibility to increase basis of computation as a result of investment being written off. Means post investment also, that you would see where it is kind of again discount. It means where the fund managers will announce discount. Discount is kind of again write-off. Write-off it means to allow investors to not to pay the fees. So that term we call it as a write-off. Write it off. Announce the write-off in that way. All right. Let's see. Okay. So here again important one. So why the terms are important? Because without understanding the terms, you cannot calculate anything as such. Right? All these terms that you would see on a investment document, right? On a LP limited partners agreement. So if you see, it's an important term that you would see here: management fee offset, allocation of transaction fees. We have seen above that we adjust or offset against the management fees, but most of the time security exchange allowed, security exchange commission, it means regulator allowed fees shifted to an affiliated company to avoid management fees offset. Affiliated company means what exactly? Let's say I'm investing in TCS. I'm a manager. So I can shift, let's say 100 dollar, which is a required, means investment cost is required, then I can shift that $100 to the TCS. So TCS will bear the $100 because they want the money, right? They want the money. So then I can shift that $100 to the TCS. So TCS will pay it. I'll not pay the transaction fees and all. Means fund will not pay it. That also happened. So it means I can transfer that fees or shift that fees on a affiliated company or investment company, I would say, wherever that I'm going to invest on behalf of fund. So that company, means TCS or Infosys or other companies, they'll bear the fees or they'll pay the fees. That also happens. So when you check the transaction, so you might get confused in calculation, because with the, let's say, X fund, you're seeing that this monitoring fee has been offsetted, and with the other fund, fee monitoring or transaction fees is not been offsetted. So you don't need to get confused. Check their terms, check the investment terms, so what they have defined or designed, so that will guide you. Then as per that, you can calculate fees and apply the accounting treatment. All right. Another point, excessive monitoring fees. Excessive means high monitoring fees upon the sale of portfolio companies, which is in turn affected the value prior to the sale. So it means here, if you see excess monitoring fees at the time of sale, then you can of course offset, or your sell amount will affect it. Let's say sell amount, investment sell amount is 1 lakh USD and monitoring fees is 1000 USD. So your investment amount, means this will affect total investment value, affect 99,000. So that amount will affect. You will receive need amount, means that would be a different amount, so that you can offset it. So at the time of sell, if you see this amount, right? What else? What else? See how this terms looks like. So this is the investment document. Investment document, it means actual documents looks like this. Terms looks like this. So now above we have discussed everything, and here if you see calculations in euros based on total commitment. As I said, they always provide you the best. Can you see this, or shall I increase the size?
Yes.
Can you see this, right?
Yes.
See, base 1 lakh euros, where you can see 1 lakh euros here,
Commitment.
right? 2% on, and here they have mentioned it, excluding GP's contribution. So it means GPs, they will not pay the management fees. So sometime they'll get the exceptions as well, right? Sometime not, but that depends on the, as I said, it's a customized investment plan. It's not in a mutual fund. Can you negotiate with mutual fund as an investor? No, right? You cannot,
No.
correct? Because you don't know even who is your fund manager. Now at the moment, like now we have a transparent system and all, so they post each and every information. Let's say who is fund manager, who is going to manage it, his expertise, experience, everything. But ultimately, you cannot negotiate with the mutual fund manager as a retail investor. But with the hedge fund or private equity, see, I'm hiring that manager, so I can negotiate with them. Or they are looking for a private investment, so they can negotiate with me. So it's a customized investment plan. It's a customized investment plan. So you might see different terms with the different investments, right? So 2% on total amount. So 2% would be 2,000 when you calculate management fees on here 1 lakh. And apart from that, if you see, the important one is investment. Investment, it means here affiliated LP, limited partners will pay 1 lakh, but in a 4 equal installments, this portion, that becomes your capital call. Am I right? So same investment. So this $1 lakh investment, that will invest in 4 equal installments. Here if you see 20, 20, 20, 20. So that becomes your capital call. Do you agree with this, guys?
Yes.
Each 20,000, you can call it as a capital call. So as an accountant, you will have to draft an email to the investor every time whenever the due date of payment is there. So you will have to send the notice to the investor. So how the notice looks like, let me see if I have any open documents quickly so that I can. Fund accounting presentation, yeah, we have it. Here, see this notice, it means which includes cash distribution or cash contribution, which includes the details of investor, right? All key information. Then investor name, distribution, it means payment date. Then capital commitment. So exactly means what is the total capital commitment? It was distribution amount. Then return of capital distribution amount and interest distribution amount. So it means return and total. If you just combine, add this, that becomes your this total distribution amount. And actual capital commitment, which is 1 million USD, which I can see, or 10 million USD I can see, right? And the important is information, redemption details. So this notice which will send out to the bank, so bank can make a payment. See this. Bank will make a payment on transaction. JP Morgan Bank cashiers or cash team, they will make a payment transfers and confirm to you. Payment has been done or made to the investor, XYZ investor, right? So that confirmation you required. Why? Then you can apply the accounting entry for a distributions. You can refer this notice and you can apply the accounting treatment to the distributions. So here, sometimes you would see means in a formal mail that you can process all these transactions, or maybe you can record the entries in the books of fund, or sometimes you would require formal means notice like this with the company seal, right? So that you might require that document also. But eventually if you say it's a notice that defines terms, so here if you see return of capital 1,68,000, interest distribution if you see 72,000, and total distributions if you see 2,40,000, where fund want to return to the investor. So this might be a callable distribution or callable interest payment, where the fund manager, they can call it if they required, right? So we'll discuss that why they're calling is callable and all. So we have that, but at the moment the theoretical aspect and all this is important for us to understand. Otherwise we have a calculator so that we can discuss each and everything. See, so we have 3 models so that we can cover. But see this theoretical terms as well. Not, this is not a theoretical, this is actual, means real in a notice, but I cannot disclose the name of that company. But this is the notice which we prepare, which we release to the bank, so bank can process the payment. And same notice also that we send out to the investor as well, so where investor, they can check it from their side. And same notice accountants refer to do the accounting of this data, where we'll have to prepare separate accounting entry for this, separate accounting entry for this, for return of capital and interest distribution. For example, let's say interest distribution account debit to cash, return of capital account debit to cash. If it is callable, then you can add word callable. Return of capital callable, interest distribution callable to cash. In that way, we'll have to prepare accounting entries as well, right? So you would see that. So it means capital call and distribution notice looks like this. Okay. So here other terms also that you would see means apart from management fees and this equal distribution of that capital call, fund expenses also you would see contributions, fund expense contributions, which I can see management fees which is 8,000 and fund contributions 20,000. Sorry, 2,000. That becomes total 10,000. Why 10,000? Might be there are. Can you calculate 2% on 1 lakh? Quick. It should be 2,000 investment period. But why it is 8,000? Total fees. Total expenses 10,020. General partners, they have contributed this amount 110 odd amount, so they have contributed as well here. 20 management fees waive off, but fund expenses contributions they have incurred it. So it means on each and every contributions fund will receive those expenses. But what about 8,000? Here we have only 2,000 total management fees. Four equal installments. Okay, so might be there are other 3 investors with the same amount. So that amounts become 4 lakh total. If they have a 4 lakh investments, 4 lakh into 2%, that becomes 8,000. So what I can relate here is, so there are 4 other investors. Their investment becomes 4 lakh. On 4 lakh, you can charge 2%. That becomes 8,000, not 80. 8,000. Right? This one. Expenses. Here, if you see, those included in your management fees means management fees and every other expenses which are included here, and net proceeds, net investment or commitment which will receive to you, that is 90,000. Right? Here are also you would see 2 different things that are very important. One, you can record those expenses separately. Other one is you can capitalize them. Once you capitalize them, it means you can include total commitment that you can record 1 lakh, and then you can separately record other expenses. If not, you can only record the net contribution which is 90 and record the other expenses separately as an expense. So you have 2 options. See, it means the point is if you update this amount in balance sheet, so that becomes your capitalized. If you update net amount in balance sheet, so it means you want to separately record those expenses. Again, this vary depends on your agreement, right? LPA terms. Check the LPA terms for each and every funds. So terms defines management fees, terms defines preferred return, terms that limited partners agreement defines your catch up, general partners 100% catch up, and then 20%. 20% it means 20% carried interest if it is applied. So you would see all these terms, and that's what you should check the LPA limited partners agreement for each and every partners. If you don't check it, then you can't calculate, or you won't be able to calculate anything as such, right? So this is the format.
What is catch up?
Catch up will discuss that later on. Catch up, it means how it works and all. So we'll discuss that with the calculations, because theoretically you won't be able to understand here. But if I walk you through the how catch-up works, then you can relate that with the calculations. Right? First catch-up, second catch-up. With practical example, we'll see that how catch-up works. So it means, say, eventually investor will receive their entire amount, investment, interest plus capital. So that process we call it as, once they received it, so that stage of that process we call it as a catch-up. Let's say investor invested 1 lakh and their accrued interest and all everything comes around 1,08,000 for per year. If you return that 1 lakh plus 8,000, so that becomes catch-up. So general partner, it means general partners. Once they return to the investors their capital, so they charge it their whatever amount that it was decided. Let's say 20%, 10%. So they'll charge it. General partners will charge it after the return of investment plus preferred return. Investment plus preferred return. Once they return to the investors, then they can charge it their commission. It is kind of a commission. So they can charge it. So here if you see this term, annualized management fees post investment. I mean, there are different scenarios where they have guided us. Year X, total management fees generated, this one. Why? See this, investment basis of management fees computation. Base is 80,000. Why 80,000? Only 80,000 may be invested, right? Where you can check this 80,000? Go and here, investment contributions. This one, right? Only invested. This one. So go down and check it. Here, basis of investment fees, 80,000. So only on the basis of investment. Post investment, it means you can calculate management fees on investment basis. And then investment contributions. We don't have any investment contributions. Less cost of investment sold of a. If you see any cost as such incurred, then you can debit that as well, right? Or write off anything as such. If you see, the net investment would be 60,000. So on 60,000, calculate it. 60,000 into 2% divided by 100. 1220, 1200. So for next year, they will receive 1220 as a management fees, right? Annual management fees post investment period X plus 1. So it means maybe to the second year, this would be, see, investment contribution is remain same, then less cost of investment sold, there is nothing. Investment A and B, so we have two. If you sold the investment, if you don't have an investment, then you cannot charge it. Eventually, investment, it should be, so you should have a live investment. If you sold it, then you cannot charge anything as such. And then investment less write-offs, anything as such, if you see. So after deduction of all, so net investment becomes live, means whatever investment that you have under management, I can say. Eventually that becomes you under management 2400. So you can charge to the third year, you can charge management fees on 24,000. So this is how, patterns, they follow the patterns and charge management fees. And that's what you should check the investment documents while calculating the management fees or any expenses as such. So that guide you how you can calculate the management fees how you can apply the accounting treatment, and many more. Here total investment is 20, but you have a 4 into 20, that becomes 80,000. And here it means you have again 4 investments, so loss that becomes, write down loss, that becomes 20%. So 4,000 into 4, that becomes how much? 4, 80. 16,000. Cost of investment, sold investment A, 20,000. 20 80 minus 20, 0. Then again 4,000, which is write off. Down, write off, down, B same 16, 20, 20, and again investment D, write off 20,000. That becomes 250. So around this will tie with it. X plus 1, 20, 60, 20. Cost affiliated. Here they have given the description. And limited partners 20, 16, then it's 20. C is the write down. Right. There is no for C details. EB. C. Right. Other expenses. Organizational expenses of the fund. So it means fund maintain other expenses as well. Deal cost, abort, legal, professional fees, audit fees, administration, accounting. So fund maintain all other expenses as well. So we'll see how they offset it. Already we have discussed. It means fund maintain all other expenses. AIFMD, Alternative Investment Fund Manager Directive, regulatory expenses. Full form of AIFMD, Alternative Investment Fund Manager Directive. This should be for European Union. Other expenses including annual LPA, meeting expenses, out-of-pocket expenses, bank charges, FX, working capital, etc. All are the other operating expenses. Operating, it means you require all our expenses to operate the fund. Admin, accounting, all. Typically, general manager, overhead, staff, costs, salaries, bonuses, office rent, equipment, audit, accounting, legal, professional, utilities, and other office expenses, etc. LPA should be explicitly state general partners and manager overheads are not borne by the partnership. So it means you would see different expenses. Like let's say general partner and manager, see they cannot, means their expenses they cannot record in a partnership. Partnership, you can record only those expenses which are from the partnership. Right? So try to understand that as well. So it means there would be different levels of expenses. One is org level. Another one is your main fund level, right? And third level is your partnership level. Only partnership level expenses you can allocate to the partners. Fund level, that depends what are the expenses, nature of expenses and all. Org level expenses you cannot allocate to the partnership. That's very simple. So it means only expenses that you can allocate which are related to the partners. See, those are normal expenses. If you see director fees, travel expenses, they all are the expenses where they consider as the miscellaneous expenses and charge it to the partnership. Organizational expense cap usually lower of 1 and 1% total commitment or X amount. Excess organizational expenses more commonly offset against management fees. Abort cost cap, sometimes see cap on abort cost of startup fund managers. based on commitment. Multi-fund structure key to ensure that the expenses are allocated accurately across multiple funds. So as I said, depends on the fund structure. Then you can allocate the funds to the partnership, or expenses you can allocate to the partnership. Otherwise, you cannot. If you see, if expenses born or generated because of that partnership agreement, whether it is organizational expenses or any fund level expenses, you can record it. But if not, if you see don't relation, means if there is no relation of that particular expenses with the partnership, then you cannot record it. So check the relationship of that expenses as well. Key points: broken deal, it means let's say any investment if got cancelled, those expenses you can call it as abort or broken deal expenses. Let's say it was decided, everything decided that you're going to invest in GMT Academy as a private equity fund, but at the last moment I have cancelled the deal from my side. So that, see, every deal incurs some expenses, every deal comes with some expense, so that will apply to you ultimately. All right, so understand that also. Cancel expenses and all that will be again charged to the investor. Main funds you can allocate it not to the co-investment. It means if you see any sub investment portfolio and also you cannot allocate that. Fund level you can apply to the fund level. Service provider fees reduction negotiated but benefit not passed on to the funds and applied to the internal entities. General and fund manager overheads allocation. Some of the GPs overheads like rent and non reimbursable travel cost allocated to the fund. So all expenses that you can allocate to the funds or partnership or organizations. So see, when we say SEC, it's a very important aspect that you should always think about. SEC, it means Security Exchange Commission define that. So Security Exchange Commission, it is allowed to record the expenses. So it means you can record it. In a legal way, that is allowed to record the expenses. And finally here, we are at distribution, waterfall and carried interest. Pure deal by deal model. Most of the UK fund, they prefer it deal by deal. Sorry, US funds, they prefer deal by deal model. US funds, they prefer deal by deal model, and whole deal model preferred by the UK fund managers. UK fund managers. Why UK and why this? If you see preferred by LP, so it means investor like this model, whole deal model, investor like this. So tell me the reason why investor like whole deal model. Because this model ensures interest plus principal repayment first. This model, whole deal model, ensure interest plus principal repayment first, and then after commission will charge, which you can call it as a catch up. Commission will charge after the repayment of all investment from all the deals, not only one. Let's say one investor invested in 10 deals. So until the repayment of principal and interest payment of 10 deals, so managers cannot charge catch up. So that is all about your whole deal model. Commission will not charge. So it means whole deal model, whole of fund deal model will ensure it interest payment and principal payment, total principal payment and total interest payment from across all the deals or investments, right? So that model will ensure it repayment. It's a very important one. And whole deal model, it's a US based model preferred by GP, general partners. So it means fund managers. Here after every deal, let's say fund invested in A, B, C. Once the B investment mature, then you can perform your distributions, and where fund manager will charge the commission, right? Means after every deal, fund manager will charge the commission. So here, pure deal by deal model support to the fund managers or general partners, and whole deal model support to the limited partners. It means investor. So most of the investors, they prefer. So you might expect question on this part in your interview process. So I would request you to please note it down this portion. Whole deal model support to the investor that ensure the interest payment and principal, repayment from across all the deals. Then after only commission or catch up will be charged by the general partners to the investors. And deal by deal model, it means it ensures the catch up after each and every deals. For example, let's say the fund invested in different companies like ABC. So after the proceeds received from each company, the fund managers or general partners will charge their commission or their portion catch up. They'll charge it, right? And here hybrid, it means cumulative deal by deal model. Again, it's a deal by deal model, but hybrid. So let's see. I haven't even. I see this is first time. I was aware about this too. Cumulative, how it works, I'll have to check it. US waterfall model. US, it means this deal by deal model. That is your US model. Okay. So basically, it's average. It means support to both. I believe hybrid model that carry the feature of this as well as this also. That becomes your hybrid model. So it means offer the feature of both whole fund and deal by deal fund. Distribution and waterfall carried interest. Okay, cumulative return of realized capital and cost additionally investment return of. Whole deal model return of all aggregated. See this. Here we have a discussion. We have already discussed it, but again, return of all aggregates contributions, return of all aggregates preferred return, whole deal model. Carry escrow is less critical, minimize clawback risk, lower risk. We'll see that clawback and all in private equity, how it works. Then wider accountability and long-term approach. And from GP perspective, may not always be right motivational tool for individual carry holders. But here, the two features which are important, where the whole fund or deal, whole fund deal model offered to the investor, right? And cumulative one, return of realized capital and cost additionally investment return of preferred return on above investment amount only, outstanding on unrealized investment and remaining shares of expenses. Carry escrow is important. Higher risk of clawback could promote speculative approach among some deal team members. Better motivational tool and earlier carry receipt can assist with commitment to subsequent fund. So it means eventually this model which helps to the fund managers to generate the commission, generate the revenue after every deals. So fund manager don't, let's say investment duration is 10 years, and after every 1 year, if let's say one deal get mature or investment get mature, so after every investment fund manager can charge commission here, but here they cannot. Under whole deal model, see in a name itself you can see everything. Whole, it means first of all return the entire preferred return and interest payment to the investor. Here deal by deal, it means after every investment fund manager will come into picture and charge their commission, right? So that's the difference. So we have example, practical examples, calculator and all. So we'll see that with the terms, but let me just walk you through. Distributions, we'll see it differently. We don't need to see it here. We have a calculator and all. So here there are two important assumptions, or I would say practical considerations that you can see. Headline: cash funded contribution in and out is fairly visible and easy to track. So it means, so they actually see cash plays very crucial role in and out, right? If you see this portion, catch up, final split, preferred return, return of cumulative, general partners investment as to distribution, waterfall and carried interest. Cash funded contribution in and out is fairly visible and easy to track. So okay, so it means in a practical approach, so that it's important to understand the funded contribution and unfunded. So accordingly, you can calculate the all of the benefits. Then it is the common component which we have seen. Common component after the repayment of contributions, especially preferred return, that are times harder to see directly. It is the component after repayment of contributions, especially preferred return, that are at times harder to see directly. It is component after repayment of contributions, okay, especially preferred return, that are times harder to see directly. And then for age, these scenarios and hard hurdle arrangement, the accuracy of the preferred return is critical. And also the final split of remaining cash element is straightforward, 80-20. The basis as per LPA. So it means, so all these terms which we can see means at the time of calculation you can relate it, how we can split this 80-20%. Then for age, say scenarios and hard hurdle arrangement, the accuracy of the preferred return is critical, and it is the component after the repayment of the contribution, especially preferred return, that are at a time so harder to say directly. So I am aware about this one, but this too fairly even I'm aware about this one. So it means you can funded amount directly, you can disclose it. So we'll see that here if the example, if they have mentioned any as such funded amount and unfunded amount. Affiliate contributions, return of investors, funded and funded.
Could you please increase the font?
Yeah, it's a presentation slide. Let me.
And the calculations.
You don't need to check these calculations because I have a calculations in Excel sheet. That would easy because after each and every time you would see in deep calculations. We'll do it means in the next session we'll cover that out. All the key calculations with management fees, preferred, catch up, carry. We'll do this. Return of investment. So key considerations. I just want to understand this too. This one I know it. Because I have worked on it. So I know, even though I'm aware about this as well, headline cash funded contributions in and out is fairly visible and easy to track. So the two key elements of the waterfall calculation is, while calculating the waterfall calculations, especially preferred returns and general GP's catch up, So two things are very important. One is contributions or funded amount, how much amount it was funded, means in and out. So that the one element is required, and apart from this, this portion like split on the remaining amount. This is also that I can relate. I know, but I'm trying to understand this one. It is the component after the repayment of the contribution. Okay, repayment of contributions, especially preferred return. Okay, preferred return and this that the are at a times harder to see directly. Got it? So it means those are the practical consideration. It means sometimes it would be difficult to say it just because of inflow and outflow of funds. Because every time you would see cash will receive, cash will out, and that gets difficult to calculate and see easily. And apart from third is age case. Okay, age case scenarios and hard hurdle arrangement that the accuracy of the preferred return is critical. Due to hard hurdle arrangement, accuracy of the preferred return is critical. So those are the practical consideration. It means where regulator also know it, where it is difficult to say it accurate accuracy, but we try to calculate, means every fund accountants try to calculate preferred return accurately. So if you see here also in the calci, we try to calculate preferred return 8% approximate. So it means this approximate, why we use approximate? So nobody can calculate surely, and that is allowed in private equity. It should, we try to calculate accurately, but it would be approximate, not the exact one. And the same, if you see, they have briefed in here as well. Their statement is for edge case scenarios and hard hurdle arrangement, the accuracy of the preferred return is critical. So it means nobody can surely calculate and give it guarantee that this is the accurate one. Approximate, everyone can calculate, and that is allowed. And that's what it says, practical consideration. So it means while calculating, we have test few examples, and then we got to know. So that amount that wouldn't be means exact. So you would always see little difference here and there. That is allowed. Right. Then other considerations, preferred return structure as interest calculation or internal rate of return. Interest calculation, that is easy. Compounded interest computation. There would be two types of interest payments. One is simple. There are two types of interest payment calculations. One is simple interest. Note down this one, please. Simple and compounding. Compounding, it means, for example, let's say for first year you invested 1 lakh with 10% interest payment. So that becomes your interest plus principal. Let's say interest is 10,000 for per year. So total investment for next year would be 1,10,000. So next year you can calculate 10% on this amount. So it becomes 11,000, right? 11,000 plus this 1,21,000. That would be for a third year. So in that way you can calculate your compounding. So it means investor will receive compounding return on investment, right? For that interest payment. So we have this calculation, practical calculation. I'll walk you through. Simple, it means you don't need to compound it. Every year you can just add 10% for per annum, 10% on your commitment, main commitment, 10,000, 10,000, 10,000. So you can add that. Preferred return is the, see, in a hedge fund, we have a high watermark. High watermark, can anyone explain me? High watermark, it means what exactly? High watermark. Come on. In a private equity, we have a high watermark, right? Guys, are you there?
Yes, Raj.
So are you aware about high watermark? High watermark, high watermark.
Yeah, it's about
Hmm?
the hurdle rate.
High watermark, it means it's a benchmark, right? Let's say you have invested 1000 and hedge fund manager committed so that they'll deliver 10% return. So it means 10% on this amount. So it becomes
Above the
your,
hurdle rate, right?
yes. So it means benchmark is this. So minimum expected return is this one, right? 1 lakh, sorry, 11,000, correct? Because high watermark is 10% on base amount. So here also 8% would be your preferred return, that on your investment, whatever investment that you made or that you have done with the XYZ fund will at least ensure 8% as a preferred return. So it can be simple or compounding. It can be simple and compounding. But if you see compounded interest return computation typically gives higher return to the LPs than the internal rate of return. Internal rate of return calculations taking into two cumulative cash inflows and outflows to arrive at a final cash flow distributions amount that is required to achieve the stipulated internal rate of return and hurdle rate. So here two ways preferred return can be calculated. One depends on the interest payment, let's say 8%, 9%, 6%. And another one is depends on the cash that the fund received it. On the basis of that, fund can calculate the IRR. So calculations, IRR, and this one will discuss because in next session with the calculation part still which is pending. So don't worry about it. All are as per the regulations or the guidance, I would say security exchange guidance, we need to discuss all these terms, and that's what we have covered it almost all the portions, right? Theoretical terms, so which you might see in your interview. So those are important one, right? Preferred return. So here you are try to just at the moment you can keep in mind preferred return can be calculated in two ways. One is interest calculation and another one is IRR, internal rate of return. We'll see that formula of internal rate of return and interest calculation. And here you would see again two types. One is simple and another one is compounding. How compounding and simple works, I just give you brief but with the example so you can relate that what it means exactly. Okay. Pass minute the call for right. Then drawdown dates. We usually suggest using the drawdown due dates rather than actual payment dates of a different investor unless there are significant delays in actual payment and default date. So drawdown date, it means so every fund account fund they set up the actual dates when the payment that they'll receive. They set up the dates, right? But here if you see we usually suggest using the drawdown due dates rather than actual payment dates of a different investor. So eventually investor always, so if you see delay in payment as well, drawdown actually that is your payment date, but you would see delays as well. So if you see delays as well, then you need to do accounting accordingly. Drawdown, it means your capital call. So you have requested payment to the investor. Let's say what if investor submitted check payment? In that case, you would see the difference between the drawdown date and payment date. What if you have, let's say the drawdown date setup is, let's say today's date, but today's bank holiday, so definitely you will receive payment on Monday, right? So what if let's say date was on Friday and payment that it will receive you on Monday? Again you would see difference between drawdown dates and payment dates, and that's what it suggests for accounting, usually suggest using the drawdown due dates rather than actual payment dates, because it can be different dates due to the different exceptions that would be in a process where sometime investor will take a little higher time to process the payment, sometime payment will receive to you lately due to bank holidays and all, and then there would be delay in the payment dates, right? Annual compounding could be done on calendar year basis or anniversary of the first drawdown. Compounding, it means, so when you can compound the preferred return 8%. Anniversary, when we say anniversary, it means when, let's say, last year payment, let's say we had received on 2/7 to 20 to 23, right? Sorry, 22. So if you see on this date, if you, let's say you had received payment, last drawdown payment you had received on 2/7/2022. So it means today that you can compound it. Today you can perform the compounding for this particular, let's say, drawdown or capital call, whatever that you had received last year. So you can perform the calculation today to compound it. Anniversary. It's important one. Anniversary, it means on same date, at the closing of same date, you can convert that interest payment into compounding and again recalculate and update your financial statements. So you need to also check that as well. See, eventually we set up all these dates, means when you can perform compounding and all, everything that will be set up in your system. You just need to check it, all the key aspects, and accordingly you can apply the accounting treatments. All are the rules, not the in detail theoretical aspect. Means that rules or practical aspects which you would see at a ground level, that you need to follow while calculating the preferred return and account, even applying accounting treatment. Also you should always look for a practical consideration. Otherwise you cannot, means once you calculate it, that won't be a proper way or accurately, right? So always ensure that as well. So on anniversary, so you might expect question in your interview process, when you can compound it interest rate. Of course on anniversary, or you can also follow the calendar days as well. Calendar days, it means at the time of investment, let's say you have decided to follow 30 divided by 360. So you can follow that as well. After 360, you can compound it. Depends on your investment cycle. But most of the investments, they follow the anniversary. Anniversary, it means same day of investment in next year. Third point, return of unused contributions. It will be excluded from the calculation of return within a specified number of days as per the LPA. So let's say I have received capital call. I had a plan, it was in place, but due to some emergency, investment got cancelled or the deal got aborted. Then what can I do with that amount, right? What can I do with that raised amount? Let's say, for example, let's take it in other way around. You sent me 1 crore for investment into GMT Academy, but due to unexpected events, now I cannot go ahead with your 1 CR. Now I want to return that to you, right? So I can initiate the return. Unused commitments, it means I haven't used it. I raised fund, you sent it to me, but now I don't want to use it. Because once the investor pay that commitment, investors start to charge 8% interest payment effective from the payment date. So it's a essential aspect to understand that when you received fund and if you don't have an investment plan, then you cannot keep that fund with you. You will have to return it out by hook or by crook. If you don't it, then that will affect on the expenses of the fund. So fund expenses will incur it. If you don't have an investment plan, then don't keep that investment with you. Simple. Return that investor. LPA means limited partners agreements that provide, or you can make a provision for that as well. Okay. Catch up, straightforward, practical aspect that you would see. Return the investor, straightforward and calculated as a gross up percentage of limited partners profit distributed. So return the investor whatever portion is that you had received from them. So return that first, and then you can, on further part, you can calculate your catch up. Split, it means we'll see that split, how split works. but you would see variations and all, but you can also directly split that 20%, 90%, or directly see, means there would be different scenarios which you would see while splitting the fees. But the best approach is 80 to 20. 80 means to the LP and 20 is to the GP. So that you can see. But on a ground level, you would see this as well. So 2/3, 1/3 language. This is the language which you would see in a statement. So accordingly, we'll have to calculate it out. But while calculating, we'll take that few examples, so which you can relate. Recent trends from our LPA reviews, limited partnership agreements, what we have reviewed it like 80 to 85% whole of fund model and 50 to 20% from hybrid and cumulative deal models. So most of the models are whole deal models, because see, fund managers nowadays, as I said, limited partners, they want in detailed analysis of the investment, or they're scrutinizing the investment. So it means most of the investment they are looking for whole deal model. See, always investor will look for a safer side or protection of investment, and whole deal model is best one. And if the whole deal model is not exist, then they're okay with the 50 to 20% means hybrid investment as well, right? Cumulative deal by deal, mostly, as I said, only few investors they'll prefer it, not all. Because from an investor perspective, every investor's objective would be to get the principal and interest payment back as soon as possible, or as soon as early. That's the main motto of the investor will have, or would be, I would say. Even though at an individual level, if you want to invest in XYZ fund, what would be your priority? Of course, return on investment, but duration, always you would expect lesser the duration. For example, let's say there is one investment here, required PBP, payback period is required 2 years. So it means once you invest 1 CR, you will get amount in 2 years. So there is one more investment, same investment, 1 CR, PBP is required, let's say 5 years. There is no difference in return. Let's say this is also offering 10% and this is also offering 10%. So which one would you prefer? Of course, this one, because lesser the duration, that reduce the risk. Same logic you can apply to your whole deal model. Whole deal model ensure that repayment of interest and principal of limited partners early, and that's the best advantage where they can reinvest it. So it means if the investor receives their capital and interest payment within 2 years, they can reinvest it in other deals as well. So that help them to multiply their assets. Okay. And deal by deal model, you would see different, lags. From an investor perspective, that is not a good model, right? Hybrid models, there is a good mix of return of all expenses and pro rata expenses. So most of the investor, they would prefer hybrid model as well. Preferred return, again, so this is the latest one. So still we don't see any change in the benchmark. The reason is inflation, again, still in line, that you would see around 8%, 7%. But recently in US it was high, in UK also it is high, but again, so there is no change in it. If the inflation continues, see, this rate differs, or this rate bases your inflation, country's inflation. If the country's inflation goes high for 1 or 2 quarter or 1 year, then ultimately it will affect on this percentage as well. It will increase from 8 to 12 in between. I'm sure it will increase, but at the moment I would say 8% is also still attractive, right? So this preferred return would in line with the central bank's interest rates. If you see India central bank, they charge around 7 to 8%, means they pay 7 to 8% on treasury bills. So same rate you would see here as well with the preferred return. So they ensure it, right? Escrow provision, US fund typically less than 30%, European funds typically greater than 30% distribution helps. So it means fund managers, they need to, if they received any distributions, they need to maintain the escrow account and to park the funds to complete the deal period. After that they can utilize it. So we'll discuss that how this escrow works while calculating the all these terms in a calculator so that you can relate it. Escrow means, again, escrow, it's an emergency account which you can create to complete the deals. For example, let's say there is one buyer and one seller. They have appointed JP Morgan as a bank. So buyer will pay 1 lakh USD, right? And seller will receive 1 lakh USD. But apart from that, what about goods, or what about quantity? That also it needs to be transferred, right? Quantity also needs to be transferred, because seller will transfer the quantity to buyer and buyer will pay the amount to the seller. But both the confirmation, it should be means both the transaction executed at the same point in time. If not, then there would be risk. Then what are these? What would be the JP Morgan rules in this picture is, JP Morgan will request to the buyer to transfer the amount 1 lakh to the JP Morgan's escrow account. Escrow means emergency account. And also JP Morgan will request to the seller to ensure the delivery of goods or quantity or share payments to the buyer. Once the buyer confirm about the payment, means security payment, then JP Morgan will release the payment to the seller. So JP Morgan maintain the escrow account, and that's what you would have heard term even escrow agent. So it means bank plays the crucial role as escrow agents, and they offer the facility and they ensure the clearance of deal as well, right? And then frequency of clawback we'll discuss in our next session. Meanwhile, you can search about the clawbacks on internet and see what information you would get about the clawback. All right. So I would say we should stay here. There are many more other slides as well. Theoretical aspect, it means all these aspects will help you to crack the interview. There are many more things, right? So further part we can cover in our next session. Meanwhile, I'll send you the recordings. You can go through it in the recordings that you want and try to prepare your notes as well. All this today's input that you would see means while working on a private equity fund accounting funds, all these terms which you can see on paper or maybe on documents, so which you can relate, because we have prepared this presentation on the basis of the real scenarios after the reviews of LPA documents and all, or financial statements of private equity and all. Then we have prepared it. Okay, so if you want to refer, you can. The same documents already I have updated in your course as well. Further part we'll discuss in our next session. And then finally we can have calculations. For calculations, we have a different models which we have designed. So I'll help you to understand, and their accounting entries, because in a private equity accounting, you would see different entries. Different, it means same, but with a different name. And calculations as well. Catch up, carried interest, how deal by deal model works and all. So we can see that. And even I'll explain you how compounding works. Preferred return at all. Okay, IRR. So don't miss the next session, I would say. Be there and try to understand the complex terms. All right. So now you can unmute, and if you have any question as such, so please go ahead and ask your questions. I would like to take your questions. Otherwise, I'm done with the today's session. Guys, any question? If you have. Am I audible? Swati? You are not audible. You guys are not audible. If I'm audible or not, even I don't know.
Yes, you are audible.
Okay. Any question? Okay, I'll take it as you don't have any questions. And if you don't have any questions, further part we'll discuss in our next session.